Welcome to the deep dive. We're jumping straight into American Airlines Q3 2025 results and, maybe more importantly, their updated guidance.
Yeah, it's quite the story.
Our mission here is really to figure out why a quarter showing a loss has management sounding so, well, bullish about 2026 and beyond. We need to unpack the numbers and see what these strategic bets really are.
Right. It's like management saying, look over here at the future, not so much at this past quarter. The Q3 numbers, they feel like the cost of setting up what they see as a big structural shift in profitability.
Okay, so the immediate numbers. Let's get the scorecard out. Revenue first looks solid, actually. A record third quarter, $13.7 billion.
Yep. Total operating revenues up just slightly, 0.3% year over year.
But then there's the loss. That's the headline grabber, isn't it?
It is a GAAP net loss of $114 million or 0.7 cents per share. Now, GAAP means everything's in there, including maybe some one-off charges, restructuring costs, that sort of thing. Management was pretty quick to point out the adjusted net loss, taking out those special items, was $111 million or the same 0.17 per share. And they noted that was actually at the, better end of what they guided back in July.
Right, so the loss is there on paper, but it might include things like, say, costs for retiring older planes or maybe some non-cash accounting stuff from labor deals.
Exactly, which is why if you look at operating income, just revenue, minus the day-to-day operating costs that actually jumped.
Jumped how much?
To $151 million. That's up almost 70%, 69.4% over Q3 last year. So that does suggest the core operations are getting tighter, costs are being managed.
Okay, so better underlying performance. What about pricing? Unit revenues.
That's where it gets really interesting. Overall, for the quarter, unit revenues were down 1.9%, but the trend within the quarter is the key thing they highlighted.
Right, let's just quickly define unit revenue for listeners. It's basically the money they make for each seat flown 1 mile. Tells you if planes are full and fares are strong.
Precisely. And while the whole quarter was down, sequentially, month by month, things got better. And here's the nugget. September actually produced positive unit revenue growth compared to last September.
Positive growth in September.
Yeah.
Okay.
So think of it like Q2 was maybe down significantly, Q3 started down but improved, and by September, they're back to year-over-year growth. That stabilization is a really big signal.
And what's driving that stabilization? Still the premium cabin story.
Very much so. Premium unit revenue growth beat the main cabin again by about 5 points this quarter. That's been a consistent theme all year.
People are still willing to pay for the better seats, it seems.
And that willingness, well, that's kind of the foundation for everything they're planning next.
Okay, so stabilization is good, but let's pivot to that forward guidance. You said it was aggressive. How aggressive are we talking for Q4?
Extremely aggressive, I'd say. It signals a huge amount of confidence. They're guiding Q4 adjusted earnings per share to between $45 and 75 cents.
45 to 75 cents. How does that compare?
We'll put it this way. The middle of that range, $1.60, is more than double the midpoint of the Q4 guidance they implied just 3 months ago, back in July.
Wow, okay. That's a significant upward revision.
It really is. And that obviously pulls up their full year 2025 adjusted EPS guidance too, now expected between 65 and 95 per share. Basically, they're banking on a very strong finish to the year.
And operationally, what are they planning? More flying?
Yep. Capacity measured in available seat miles, or ASMs, is expected to be up about 3.0% to 5.0% compared to Q4 last year.
Okay.
And total revenue is forecast to grow right alongside that, also up 3.0% to 5.0%.
So if revenue and capacity grow at roughly the same rate,
Yeah.
let's say they hit the midpoint, 4% growth in both.
Yeah,
That implies unit revenue in Q4 will be flat compared to last year.
exactly. Flat year over year. And considering Q2 was down 2.7% and Q3 was down 1.9%, getting back to flat is it's a significant sequential step up. It signals pricing power is returning.
Right, a return to stability in the core airline revenue.
Yeah, and cash flow. Anchoring all this, they expect full-year free cash flow to be over $1 billion.
Over $1 billion.
Yeah, and that's key, right? That free cash flow is what lets them pay down debt and fund these big strategic initiatives we need to talk about.
Okay, because the short-term numbers, the guidance, it only really matters if that long-term story holds water. So what are these big levers management is betting on for, like, structural profitability changes in 2026 and beyond?
It really boils down to 2 main things. Loyalty, the AAdvantage program, and premium seats, the actual hard product on the planes.
Let's start with loyalty. AAdvantage.
Okay, so active accounts are growing, up 7% year over year. They even called out Chicago, which is a super competitive hub, seeing 20% growth in new enrollment.
20% in Chicago. Wow.
Yeah. And the people who have the co-branded credit cards, they're spending more. Card spend was up 9% year over year.
And the big catalyst there is the new city deal starting soon, right? January 2026.
That's the one. The exclusive expanded partnership. And look, this isn't just tinkering around the edges. They're talking about a fundamental shift here.
How fundamental.
They project that the money coming in from these co-brand cards and other loyalty partners will hit around $10 billion a year towards the end of the decade.
$10 billion a year from loyalty.
Yeah. And here's the kicker. They estimate this provides an incremental annual benefit to operating income of about $1.5 billion compared to 2024 levels.
Wait, hang on. An extra $1.5 billion in operating income just from the loyalty program changes?
That's the projection.
That's huge. That number alone is more operating profit than the entire airline made in some pretty decent years pre-pandemic.
Exactly. It fundamentally changes the profile of the business, doesn't it?
It really does. It makes them less of a pure airline, flying middle tubes, and more of a high-margin loyalty and data company that happens to run an airline.
That's a good way to put it. And think about it. That $1.5 billion stream, it's much less volatile, right? It sort of de-risks the core airline operation from things like fuel spikes or bad weather impacting quarterly results.
Incredible. Okay, that's loyalty.
Yeah.
What about the premium hard product? The seats themselves. They're investing heavily there, too.
Oh, yeah. Very aggressive strategy. The plan is to grow the number of premium seats, that's your business. First, premium economy at nearly twice the rate they grow main cabin seats.
Twice the rate.
And specifically the lie-flat seats, the really high-yield ones, they project capacity for those will grow by over 50% by the end of the decade.
50% growth in lie-flat seats. That's massive. That must require enormous capital investment. Are they sure the demand will be there, especially if the economy gets shaky?
Yeah.
They mentioned premium leisure is driving 65% of that now.
It absolutely requires huge investment, no doubt. That probably explains some of those special items in the gap loss, right? Funding these changes. Their confidence comes from this idea of a post-pandemic new normal. Meaning they believe that the higher-spending leisure traveler who discovered premium cabins during the pandemic is here to stay and has proven surprisingly resilient. They're betting that even if overall travel softens a bit, this top-end segment will stay strong enough to fill that extra 50% capacity. It's a bet on capturing high-value market share.
And they're seeing positive signs already.
Yeah, they pointed to the new flagship suite seats on their Boeing 787-9s, said those planes had the highest customer satisfaction scores among their wide bodies in Q3.
Okay, so the product resonates.
And they're rolling it out further. It's going on the new Airbus A321 XLRs when they arrive, and also onto the existing 777 fleet. But the really interesting bit of news was the plan for the 777-200s.
The older 7777s, what are they doing there?
A full retrofit, nose to tail. They're taking these older, already paid-for planes and completely reconfiguring the cabins.
To add more premium seats.
Exactly. The retrofit increases the number of lie-flat and premium economy seats on those specific aircraft by 25%.
So instead of retiring them, they're squeezing more high-margin revenue out of existing assets. That's smart.
It's very smart asset utilization, boosts premium inventory significantly without buying brand new wide bodies for all of it.
Okay, so loyalty and premium seats are the big internal drivers. What about getting those premium customers, the sales side? Corporate travel seemed to be recovering too.
It did. Corporate revenue was up 14% year over year in Q3. That's a good sign, especially after, some of the friction they had with their distribution strategy changes.
Right, the move towards more direct booking.
Yeah. They basically said they expect to get back all the market share they might have lost in the corporate agency channel by the end of this year, 2025. And now the goal is to actually grow beyond their historical share. It's all connected, having the right premium product and making it easy for high-value travelers and corporate clients to book it.
Makes sense.
Yeah.
Okay, let's quickly touch on the cost side and the balance sheet. Investing is great, but you have to keep costs in check and manage debt.
Absolutely. So CSMX, that's cost per available seat mile, excluding fuel and the special items, they expect that to be up 2.5% to 4.5% in Q4 year over year.
Which sounds like cost inflation, but
But they also highlighted they've already achieved $750 million in annual savings compared to 2023 through ongoing efficiency work. These aren't just one-time cuts, they're structural improvements.
and having labor deals locked in through 2027 Probably helps focus on that long-term efficiency, right? No near-term contract battles looming.
Definitely provides stability. And on the balance sheet, they're making steady progress on debt.
How much progress?
Total debt ended Q3 at $36.8 billion. That's down $1.2 billion just from the previous quarter, Q2. They said they're actually running ahead of schedule on their plan to get total debt below $35 billion by the end of 2027.
Okay, so chipping away at that debt load while investing. And liquidity. Enough cash on hand.
Seems so. They finished Q3 with $10.3 billion in total available liquidity, cash, and credit lines, so plenty of cushion there.
And operationally, things ran smoothly despite challenges.
Yeah, they specifically mentioned dealing well with summer weather and that FAA tech outage in September, credited their own tech investments for being able to recover quickly, and they're being strategic about growth, focusing on restoring and growing key hubs like Chicago, planning over 500 departures a day there next year, plus Philly and New York. You need strong hubs to support that premium network.
Okay, so wrapping this up. The Q3 loss, while notable, feels like it's being deliberately positioned as sort of old news by management.
Pretty much. The focus is squarely on these huge, specific targets driven by loyalty and the premium cabin build-out over the next few years. This whole earnings report felt less about Q3 results and more about validating their path towards a structurally different, more profitable airline by 2026.
But it does raise that big question you touched on earlier. They're building all this premium capacity that 50% lie-flat growth is enormous based on this new normal of strong premium leisure demand, which they say fills 65% of those seats now. If the economy does face headwinds, does that huge investment in premium become their ace card, capturing every last high-yield traveler out there? Or does it risk becoming expensive, empty capacity if that specific segment pulls back?
That's the billion-dollar question, isn't it? Their commitment is clear, though. It really defines their strategy now.
And sets them apart from competitors who maybe aren't leaning quite so heavily into that premium leisure shift.
Definitely positions them differently.
So a final thought for you, the listener, to consider. How might that projected $1.5 billion annual operating income boost from loyalty profit that's basically disconnected from actually flying planes insulate American from the typical boom and bust cycles of the airline industry, especially compared to rivals without such a powerful non-operational profit engine? That recurring loyalty income could be the real game changer here.